It's interesting we hear countries like Indonesia speaking almost in a very blunt way to Powell about just warning about the spillover effects that this tightening policy will have in this part of the world. Do you think the Fed, I mean, we've asked this question most of the year already, but do you think the Fed can continue to ignore these risks?
Well, clearly we have seen that Powell has been pretty adamant that he's going to be focusing mostly on what's happening in the United States and shifting the paradigm of the Fed, looking at not at only at the neutral rates as we were thinking about the Fed policy action in the previous compound with Yellen being in charge. I think we're now looking at continuous rate hikes in the next year at least. So probably Powell will be more focused on what is the real economy doing in the United States rather than paying attention to either Indonesian comments or even comments from Donald Trump.
Now, Yerlan, this time last year, a lot of us were talking about the shortage of dollars in the system. Dollar liquidity has certainly become an issue this year. It's a bit surprising how some people think it's a big surprise we're actually in this situation. Now, the reason I bring that up is when you look ahead to 2019, we know where Jay Powell wants to take interest rates. Should we expect the same sort of pain and situation for emerging markets to continue because of what Jay Powell says?
Well, certainly it hurts if you have global funding rates going higher. That definitely will put pressure on emerging markets, and the spreads clearly will have to reflect the opportunity for investors to earn clearly above what is the risk-free rate in the United States. And especially if it's coupled with the slowdown that we're projecting for the second half of the year in the emerging world, that obviously is going to be a more difficult story to sell.
So what worries you the most then, Yerlan? Is it the fact that we continue to see a pickup in interest rates, the Fed on this tightening path, or is there other factors that you think that could actually weigh on EM even more?
Well, clearly one of the biggest unknowns is whether we're going to be on the path of this continuous deglobalization. Recently, obviously, embodied in the trade war rhetoric that we've seen from the United States, but not only rhetoric, but obviously active steps in order to change the rules of engagement in global trade. So this is really warning. In a very simplistic terms, if we've seen in the last couple of decades a significant amount of wealth transfer to emerging countries from developed countries due to the globalization, if we're going to see a reversal of globalization reflected in what's happening now with trade, that is going to hurt emerging markets, obviously, from the growth perspective, and it's going to dent the investment thesis in emerging markets.
Speaking of thesis, buying opportunities, talk to us about what you're seeing right now.
Well, clearly we're still a little bit defensive looking at what's happening in the emerging world. Clearly, emerging market is a growth story. We still see a very robust growth. However, the gap between emerging market growth and developed market growth has been actually narrowing somewhat and is expected to narrow further. So it's not really the time for us to be extremely bullish on the emerging world from that perspective. So we will be very cautious on equities or on currencies in the emerging world. However, the hard currency bonds has always been a more defensive asset class if you wanted to be engaged in emerging markets, and I think there's still fairly good opportunities. What we really like at the moment the credits which are linked to oil. We're seeing energy as being quite strong this year, and we also see some potentially very stronger economies where we see very strong institutional frameworks and stable policy making, such as Andean countries.